We often say that as investment managers, we're actually in the business of managing risk. So at Ford, we have a top-down element to our investment approach where we think about macroeconomics, and we try to understand where we are in the cycle. Now, as part of that top-down process, we think a lot about the potential economic risks that we face as investors. And today I want to highlight 4 economic risks that we're thinking a lot about for 2023. The first is inflation. There's still a risk that inflation won't fall as quickly as the Fed would like, particularly with the US labor market being so tight. And the economy is proving a lot more resilient than expected so far. So the Fed is likely to err on the side of tightening too much rather than risk inflation becoming a longer-term threat. And while the rest of the world shares America's inflation problems, we also remain tied to its interest rate cycle. So while the US is still hiking, most countries will be forced to do the same. Which leads us to the next economic risk, which is higher than expected interest rates, or interest rates remaining higher than expected for longer. It's clear from the resilient data we're seeing that this recent tightening cycle has yet to bite. Now, the market currently expects the Fed's benchmark interest rate to rise just above 5%. That's up from close to 0 at the beginning of last year, in the most aggressive tightening cycle in 40 years. And there's quite a difference between what the Fed thinks rates will do and what the market is pricing in currently. So that's a risk that we also need to carefully consider when deciding where to invest. The third economic risk that's on our minds is that many governments are stuck with significant debt. While growth rates were higher than borrowing costs, governments could borrow very cheaply, and they did. But now that economic growth is slowing and borrowing costs have risen sharply, several countries could find themselves on an unsustainable debt trajectory unless they make painful fiscal adjustments. And spending on higher borrowing costs means that they have to redirect spending from other important areas in the economy. So the actual cost is not only the higher interest expenses, it's also the opportunity cost of where it could be spent otherwise. Now, it's also important to remember that government bond yields are not a free lunch. They're compensating investors for higher country risk premiums. In other words, investors need to be paid more because the risk of lending to countries that are already highly indebted has significantly increased. So we need to think very carefully about the risk-return trade-off there. Lastly, we're thinking quite a lot about the potential impact of geopolitical risk, which is still at quite elevated levels, and that increases the risk of negative events. We saw last year, for instance, how the Russia-Ukraine war, aside from the humanitarian considerations, had huge implications and knock-on effects for the entire global economy. The world is in a process of deglobalizing, and the tensions that creates could cause negative shocks. So from our side, it's important that we build a portfolio that has stabilizing elements in the event of geopolitical upsets. And that's why, for instance, we hold some gold in our funds currently. Importantly, we build our portfolios to withstand a variety of different scenarios. Now, all risks involve uncertainty, but we live and we invest in a world of uncertainty. If we accept this fact and we embrace it and study it, we can actually use it to our investors' advantage.